There are times where I felt like a hero, that nothing could go wrong with me. There are also equally times where I felt like a zero. In a bull cycle, everybody gets it right. Then you start thinking that you are supreme. The biggest mistakes they make is that they stop their SIPs when it starts underperforming or when there is an issue in the market. Avoiding a mistake is probably far more important than trying to find that multi-bagger. Our mid-cap fund was up 30x since launch.
Okay.
But only 20% of the investors remained, or 20-25% of the original investors remained.
78% of our viewers aren't subscribed. Help us out, folks, and hit that subscribe button and help us bring you more incredible guests. Folks, welcome to Paisa Vaisa. I'm yours, Anupam Gupta, and on today's episode, I'm thrilled to welcome back on our show, UTI Mutual Fund, my guest, Srivatsa, Executive Vice President and Fund Manager Equity at UTI AMC. Srivatsa, welcome to Paisa Vaisa. Thank you so much for doing this for our audience.
Yeah, thank you so much, Anupam. It's indeed a pleasure to be on this podcast.
Thank you so much. We've had Vitri, we've had Paisi, so it's great to have you here. You're a veteran. I mean, you started in UTI back in 2002, right? If you could go back in time, what's the one thing you would tell your younger self about the market? If you could go back in time and...
Yeah, sure. So I'll just tell them two things. One thing is there's a famous Gujarati saying, Bhav Bhagwan che, or Bhav, market is always supreme. So respect the market. Now the markets in my long career, so I've had almost 17-18 years of career as a fund manager. So there are times where I felt like a hero, that nothing could go wrong with me. There are also equally times where I felt like a zero, that I'm a complete failure in life. So the idea is to manage both parts of the spectrum. When you're a hero, go down, slow down, think about it, and don't focus on the process. Don't think that you are the supreme.
Yeah.
When you're the zero, you have the confidence, you have the track record. Just hope that the time will pass. It's not that you're a complete dumb person. So that's one of the biggest learnings that I have had. And if you're able to manage both ends, especially the first end, the second end is always easy, because once you're not doing well, you will go back to the drawing board, rethink on your strategies. But the challenge comes is when you're doing well, sometimes it could be because of luck, not skill. So you really have to even dissect your performance then and correct yourself even when you're doing well. I think that's where probably I have made a mistakes couple of times early in my career. So that's the biggest lesson that I have learned in the last 20 years.
Very interesting. You think investors are still making the same mistakes today that you once made then? When you look at investors today, especially in the retail crowd?
See, retail, I think the challenge for retail is that, they may not have the time to do a proper research. See, for us, if I'm investing a company, I'm thinking like a business owner. Like I'm thinking as if I own the company. Obviously, I own the company, but my thinking goes like that. Like I'm putting the hard-earned money of my investors into a company. Let me think like a business owner. If I'm investing in my friend's company. For a retailer, that connect is not there. It could be that some XYZ told कि ये stock अच्छा लग रहा है, ये chart अच्छा लग रहा है, वो अच्छा लग रहा है. Just go and buy it. So I think there the chances of making a mistake is far higher, because you get it right in a cycle. Say in a bull cycle, everybody gets it right. Then you start thinking that you are supreme. So I think there probably the caution is much more. But even in a professional side, I've gone through this cycle, and I'm sure most of my younger colleagues will also go through this cycle and will feel the same way. When you're doing well, you think that you're God. And there could be a letdown in the process. It's just not in our profession, in any profession. If you see in cricket, if you see in sports, if you see in acting, the moment success gets onto you, you think you're supreme and you let down the guard.
Large and mid-cap fund that you've got is quite interesting. So tell us more about it. How is it better positioned to capture opportunities than, say, either a large fund or a mid-cap fund?
Yeah, so this category is very interesting. So this category was created in 2018. And so no such fund existed with this kind of a mandate. I mean, they were either large, they were flexi cap, or they were mid.
Correct.
And there was there was no proper positioning. So for example, a fund classified as large cap would have still had a decent mid cap and vice versa. So the good thing of SEBI was that they ensured that all the funds in a category have very similar positioning in terms of allocation.
Okay.
So they created this special class. So all the funds migrated either from large caps or from mid caps or from flexi cap to this category. Now, this category is good from a structural perspective on two reasons. See, one is that obviously you need large caps. So most of the large caps today are matured.
Yeah.
Right, but they give you stability. So they could be compounders. Like for example, you may not expect, say, an HDFC bank to double in 2-3 years, but it could be a compounder of giving a certain return every year. The same would hold good for a lot of these bellwether stocks. Whereas in mid and small cap, which is say a 50% of the portfolio, that is what will give you an alpha.
Sure.
So this is a perfect fund where you're designed to give you a stability, because the large caps comes, you have compounders, you have mid caps and small caps, which will give you the kind of alpha. So it's a perfect combination of both. And obviously a guy who's able to manage it better on both sides will come out as a winner.
Very interesting. Value investing. I've read a few interviews where you talk about it. It's for our audience, value always gives this impression about finding a company that the market has not given or ascribed the right value to. How do you find a truly valuable company that pretty much everyone else is overlooking? Maybe your process.
Yeah, sure. See, I classify value into two buckets, right? The first one is pure value. Say a company with a dividend yield of 5%, company trading half-time book, or various metrics, which was what was propagated by the original value investors, whether it was Warren Buffett initially or Graham, 70, 80 years back. But the difference between then and now is that 50 years back, there existed a huge information arbitrage. Like, for example, when I started my career in 2002, you would also recollect, annual reports were very hard to get by. You had to go to a Raddiwala, or you had to be an investor to get an annual report. And obviously, you're the first one to read an annual report. You will have access to some more data which the general public may not have. So you would act on that. So a company may look very cheap because there would not be information available. You would act on it and make money. Today, that's not the case. So whether I'm an investor, whether I'm an investor managing 10,000 crores, or whether I'm a retail investor with 10,000, that annual report, presentation, podcast of the company's earnings, it's available to everybody. So I don't get any special information edge, apart from whatever my technical expertise is. So I think that arbitrage is gone. So if one was to take a bet on that bucket, that okay, this is at 5% yield, this is at 10% yield, you have to assume that the markets have looked it and given it a pass.
Okay.
So it could be a case, for example, there is a market where, very inferior quality apples are being sold. It is inferior. You have to maybe ride on your luck to pick the right one and make money. So that is one source, but not a very big source for me. But the essential thing that I would look out for, more than a yield or a price to book, is that what is it that can surprise the market? Like, for example, if I were to take exposure, say, in a mining company, or in an oil, in a oil exploration company, obviously the yield is attractive. But if I'm convinced that there is going to be the growth in, say, an iron ore mining or copper mining, or in the oil or gas production, which the market is not anticipating or market is not expecting, that would be an additional source of alpha for me.
Nice.
So that would make me look at that stock more favorably, but not the absolute yield, 5% yield or 6% yield. Coming to the first part, which is where, most of my portfolio resides, that again, I would subdivide into two. See, one thing I found in the last, maybe 7-8 years is that even for very well-established companies, it has its own valuation cycle. Like if you take the last 10 years, ITC has even traded at 15-16 times and 5% dividend yield.
Correct.
Today, probably it trades at 25 times. It has traded at 30 times. So if you make an entry at 15 times and exit at 30 times, there's a huge alpha that you have made. Right? Same thing goes with a company like, say, an Infosys or an HDFC Bank or a Sun Pharma. They go through their own challenges. And today, the nature of the market is such that some part of the market is momentum driven. So obviously, when things don't go well for a well-established company, you would find that people turn negative, more shorts happen, it moves out of certain indices. So that gives a huge opportunity to a person like me to look at it from a longer term time frame. But yes, it's an anti-momentum. I have to wait for some time. And in my mind, I assume that I buy a stock like this, I should expect a 5%, 10% fall. Otherwise, it can't be that I start and then it just gallops. No.
Yeah.
But that's a very good way of making long-term money, because most of these companies, if you see, they are, they recover, and these are all well established. I mean, if you look at the top 10,
Yes.
whether it is Bharti, whether it is Sun, they may go up and down in a 3-year, 5-year, but in a very long term, they deliver very solid returns. So
Okay.
if you're able to pick it up
Huh.
when they are at the bottom of their cycle,
Hmm.
it gives you outsized returns. The second one, what I would call for, is a lot of mid and small caps are generally underpriced. Some
Okay.
of them could be turnaround cases. Some of them could be cases where the market is not, has a bad memory. It has underperformed in the past. There's a change in management. There's a change in the business model. That's another way of kind of making alpha. So these are the two broad buckets of value that I would look out for.
And just for a small recap for our audience, large and mid cap invest in what category of stocks? I think it's still 250.
What we do is approximately 85 to 90% is in the top 250.
Okay.
The balance 10% is outside the top 250.
Okay.
That essentially gives the alpha for that fund. But
Right.
the balance, I would say the small caps, I think we try to look out for value, more growth oriented stocks, because maybe a small cap which is not well researched, you may still be able to find it at a very reasonable valuation.
Sure.
Whereas in today's market, top 250, it's very difficult to find a growth oriented stock at a reasonable valuation.
Yeah, that's what I was wondering. And since you mentioned about growth, can you just explain to our audience the difference between value investing and growth investing?
See, one thing is, in the heart, any investor, whether it is value or growth, is a growth investor at heart. If you were to ask me, would I not want to own a Titan or a Trent or an Asian Paints or a Bajaj Finance? Answer is yes. Or any 100 investors, answer is yes. These are world-class companies compounding. The question for a value investor is that what price I pay for it. That is the essential difference. Nobody would want to buy a dividend paying stock, because ultimately you just get dividends out of it. You're better off buying a fixed income. But when you're buying a stock, I think the critical issue comes is what value you would pay for it.
Okay.
So a growth investor would still say, if the stock is worth $1, he would still don't mind paying 1.2, 1.3. Because in his view, the stock could be worth $5, it could be worth $10 5 years down the line. And he doesn't mind paying that 20-30% premium to get hold of that stock. Whereas a value investor is fixated at that $1. Maybe he wants it at 90 cents. So that is the essential difference between both. But yes, in the heart of hearts, even if you were to ask me that would you not want to own any of these top quality growth stocks, answer is yes, but at the right valuation.
Very interesting. Okay, outlook on the markets. Since it's been 5 years since the lockdown, and there's a lot that's been happening in the at least in this last 1 year, thanks to geopolitics. But your outlook on the markets?
Yeah, see, I think the market today, I find it quite strange, in the sense that if I look back at 1 year, it's given negative returns or maybe break even or
Flat,
depending. And the good part is all asset classes are given. It's just not the large caps, but large, mid, and small have suffered in equal proportion. Maybe small cap has done even more. And yet, I think the market looks expensive. It's not cheap.
Wow. Okay.
So what this means is that today, we are at a stage where our P multiples are reasonably high and they are pretty elongated. And we have seen earnings cuts in the last probably 12 to 15 months, which is the reason why the market has kind of been flat. While the P levels have still remained the same. One would have expected that the market corrects 10%. There's an automatic correction in the PE levels, but that hasn't happened. But the good part is that the government has initiated a lot of measures in the last 8 months, whether it is freeing up the tax, putting money into the hands of the ordinary citizen, the latest GST reforms, the liquidity related reforms. So there is a hope that a large part of the decline that we saw will get reversed next year. And the decline that we are seeing in the last 15 months has largely come in the consumption-oriented sectors. So hopefully this will be reversed, and that would set for the tone for the markets to go up. But having said that, my belief is that the valuations are fair. One should not expect a re-rating, but yes, there is a scope for the earnings to grow up from that expected 7-8% to say a double digit, which would automatically ensure that the market gets its own due. So if you look at the trajectory of the market in the last 10 years, the first year the earnings growth was barely 3, 4, 5%. The first 5 years from say 15 to 20, and that reflected in the market growth being very similar.
Yeah.
The next 5 years
Yes.
saw an earnings growth far higher than double digit.
Correct.
Of course, the markets re-rated much more. Markets gave 5-6% more than that. But the bottom line is for the markets to grow in the medium term, 5 years, 10 years, you need earnings growth. Without that, the markets won't grow.
And you think that this earnings growth phase is just about?
It should. Logically, I think given the measures the government has taken
Yeah.
and given the base effects we have in a lot of sectors, I think it is only logical that that should gradually pick up in the
Okay.
coming quarters.
Okay. So recently you went underweight, or at least you reduced your stake in the financial sector. What are the key red flags that you look for, that tell you that either a stock or a sector is something where you'd want to pare down your position? With examples, if you can share, because that's a question that a lot of our audiences have when they're looking at the portfolio. Sometimes they're wondering whether you should sell your winners or sometimes you should sell your losers, because you'll never know what the effect will be in the future of that decision on your portfolio. But what are some of the red flags that you look out for?
I think the first is obviously I'm a very value driven person, and every year you get different sectors which are in value. Like, say, for example, 3 years back, IT sector was quoting at 30 XP. It was not value by any stretch of imagination. Today, the valuation for the large caps have come to 20. It is definitely value.
Yeah.
So I think there is an inherent sector rotation which happens every 12 to 18 months, that relatively what is looking better, whether it is IT, whether it is banking. So banking was looking very attractive 12 months, 18 months back, especially some of the large cap private sector banks which were going through their own challenges and markets had derated them. Today, I think large part of the re-rating is over, and I see better opportunities in other sectors, like, for example, IT.
Okay.
So some of the shift has happened from the banking to the IT, where the opportunities are better. But just to give a perspective on winners versus losers, I think the real challenge is from a very psychological perspective is to get rid of your losers. Because the psyche is that I have taken a loss on that, मुझे break even करने दो, then I will sell it. But in reality, what happens is that takes a very long time.
Yes, it does.
Sometimes it may never happen.
Yeah.
And then you just have a kind of a bias that let me be an holder. And then you try to convince yourself with a lot of facts saying that nahi, it has just fallen. There is a lot of hope. So for me, that is the biggest thing that I would look out for. So for
Yeah.
every company, I have a thesis. If I find that the thesis has not played out, I don't mind taking that hit and looking for better opportunities. Selling a winner is always easy because you've booked your profits. But even there, I think the question that you must ask is that what has led to the gain? If the stock has doubled, then has the PE doubled or has the earnings doubled?
Yeah.
If the earnings has doubled and the PE remains the same, then selling the stock doesn't make any sense.
Yeah.
But yes, you have your own concentration limits, risk limits, that is fine. But again, the ultimate goal of, I think, any investor is to hold on to the stock for 10 years, 15 years, make it a 100 bagger, rather than, searching for a 20% idea every year.
Yeah. That's in fact gets me to one question which I've had with some of the fund managers who've come on this show, and probably is useful for the audience also out there. Over the really longer term, what decides your portfolio performance? I'm not talking about alpha or beta, just absolute performance. Finding that 10 bagger or avoiding mistakes, right? Because I know it's a blend and a combination of both. But I've heard a lot of fund managers tell me that, if you just avoid mistakes, in general, that should hold you through. Because finding winners in a market, in a country like India, I mean, I'm not saying it's easy, but the chances of you going wrong are slightly less. It is the mistakes that kind of affect performance a lot.
I think in today's environment, yes, I would say it's more on the mistakes. But maybe 10 years back, 15 years back, finding you would need to have at least one or two multi-baggers or three or four multi-baggers to see you through. But in today's market, I would say yes, definitely avoiding a mistake is probably far, far more important than trying to find that multi-bagger. So it's a combination of both. But see, the way it works is any fund manager, any investor will make mistakes. It could be 20%, it could be 30. I think the benchmark is probably between, say, 30 and 40.
Okay.
The key challenge is that the mistake you make should not be big enough for you to impact the whole portfolio. Like if you take a case of a very famous investor like, say, Rakesh Jhunjhunwala, he has held 100 stocks, even more than 150 stocks. Probably from a stock wise, he has made a lot more mistakes. But The top 5 stocks that he
Ah,
has held for 20 years has
yeah,
covered up for even 100 stocks mistakes.
yeah.
So that is the key. That have both ends, but ensure that even if you make a mistake,
Mm,
you recognize it
mm.
and get out of it.
Very interesting.
That is the critical part of fund management, which I think even I'm trying to. I mean, of course, I have evolved, but I still find myself, learning in that space. I think if you're able to get to that space, I
Mm.
think you're home.
Yeah, the reason why I'm asking this is because, and we'll come to that in the second half of the show also, is that today when people, given the kind of money that's gone into mutual funds, the amount of SIPs flow that comes in every month, a lot of retail investors look upon the mutual fund investments like their stocks. They look at the near-term performance and decide, I'm in, I'm out, I'm in, I'm out, rather than staying the course. If you see some of your funds also that UTI has or that you have run yourself, even if you've marginally delivered 1, 2, 3% of beta over the really longer term in a country like India, it's meaningfully large on a portfolio. Only you get the benefits 15, 20 years later. And here we have people, who sit every day and they're monitoring the NAVs, and every month or every week they're saying, Acha, this went up, that went down, this is not doing well. Plus social media noise also. Top 5 mutual funds to invest. You think, this psychology of investing that has an impact on the kind of longer term performance, could be damaging also, I don't know.
Yeah, definitely it has. See, what happens is the moment you find that it's not gone well, you sell it.
Yeah.
You could be selling it at the bottom of the cycle. Like for example, I have gone through a performance cycle of 7 years, where the first 2 years my performance was very bad. Now, I did try to tell out that, like, look, my performance is bad, but my strategy is not working, value strategy
Mm.
is not working. But there weren't many takers at that point of time. In fact, they were asking me the question, why should I not sell out of your fund? Because
Yeah.
your fund has done badly. But had they stayed on, I mean, some of them have stayed and have reaped the benefit. So I have even covered up for the 2 years of underperformance.
Nice,
So
nice.
that's the way it works. So I think a frequent rebalancing or looking at a short term performance, but yes, evaluate your performance, evaluate your fund management,
Yeah,
how it is done, then take a call.
yeah.
Just because something hasn't worked for 6 months, has not worked for 1 year,
Mm.
that doesn't mean that you give up on the fund. It's the
Yeah.
same thing with stocks. So there are a lot of
Mm.
stocks I've held for 3 years,
Mm.
but I've got the return in 3 months after that.
Mm.
The whole 3 years return I've got in 3 months after that.
That is possible.
Yeah.
Yeah, yeah, yeah.
So I'm saying the same philosophy should be imbibed even within the retail investor, that yes, it's a long-term goal that you're planning on, your child's marriage or sending your child
Or
abroad
retirement.
or
Yeah,
retirement.
yeah,
Build a corpus. And today the one big exit load is tax.
yeah.
So if you change, there's a big hit that you take in the term of immediate payment of
Mm.
taxes.
Mm.
So
Mm.
that is something that also that you will have to consider.
Yeah. Folks, we're going to take a small break out here. On the other side, we'll come to questions that affect how you choose your mutual funds, the right behavior to hold them, and much more. Don't go anywhere. We'll be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
And welcome back. Shivas, you've navigated major crises like 2008, the pandemic. What are some lessons you've learned about investor psychology? See, we spoke a bit about that in the previous last question of just before we went into the break. But what are some lessons you've learned about investor psychology?
Yeah, I think in both the crises, the biggest lesson that I've learned is that when there is a liquidity drawdown, you have no idea to what levels the stocks can go down to. Like, I'll just highlight two specific cases. So I had invested in a mid cap IT company way back in 2009, or I was about to invest when I realized that the cash per share was higher than the market price. This had happened after the Satyam fiasco, where people were doubting the cash, but I did some channel checks on the cash and I realized it was genuine and the company was making profit. So I was surprised that it was available below cash. I went and bought it. I thought, I gave a pat myself on the back, boss. I found the right value stock. The stock corrected 30% after that.
From there.
Yeah.
Wow.
The reason was that there was a very big FII seller on that stock.
Oh, so nothing on fundamentals.
Nothing on fundamental. So I kept on buying. Finally, I also stopped like by 30 ho gaya. Then it went up to 40. Then in 6 months, it doubled from the original price that I bought because
Wow.
after this, slowed down. So the biggest lesson here is that there is a lot of noise which happens when these kind of crisis happens,
Right.
and people tell you the obvious. Like for example, if during the COVID people would have told you to sell hotels, sell malls, companies, or sell retail companies. But you find that, it's a 6 months impact, 1 year impact, but the companies are there for 10 years, 30 years, 40 years. So
Yeah.
that will not move the long term value much.
Huh.
So you need to have that conviction to hold on to it when there is a kind of a liquidity crisis. I think that is the most critical part for me.
Okay.
Of course, I'm very fortunate that I didn't get swayed by it, because it so happens that you have a position where you're losing money. You have 10 people telling you that, the worst is yet to come. You do get tempted to sell out. I think that's the biggest, I would say, a challenge an investor at my end or even a retail investor will face when he sees the NAV getting eroded by 20-30%.
Yeah.
He will have people saying, "Abhi बेच दो sir, फिर बाद में आप देखना."
खरीदो,
But
हाँ.
you never know when that time comes.
Yeah.
So that is the biggest lesson that I've learned in both the crises, that you should focus on the business fundamentals, and obviously, you should back it up
Yeah,
when you
yeah.
believe that there is a real asset value there and you're getting it at a deep discount.
Correct. Yeah. SIP has been the tool of the last, I think, decade, if not a slightly shorter time. A lot of new investors start with a monthly SIP. After a few years, in your experience on the data that you've seen, what are the most common mistakes they start making? When they would want to level up their portfolio, what are the mistakes they make?
I think the biggest mistakes they make is that they stop their SIPs when it starts underperforming or when there is an issue in the market. It goes on fine if you're working on a 2-year SIP. Markets have consistently gone up. You're at 10% CAGR, 15% CAGR. But the moment it starts coming down, the moment it goes into negative, that's when you start getting very nervous, and that is the time you'll come and stop your SIPs, which is, I think, the worst mistakes that investors make. So continue with them if possible. If the valuations are lower, if say for some reason the market corrects 20%, valuation comes down by 20%, that should only give you an opportunity to add to that SIP,
Sure.
not reduce it or not pause it. So the pausing of SIPs when the markets are uncertain is the biggest, so for example, in a lot of funds you see, the fund return will be far higher than what an average investor
Yeah,
makes.
the behavioral gap,
That's a
investor gap.
behavioral gap. That's an investor. So that, like for example, we did that analysis that our mid cap fund was up 30x since
Wow.
launch.
Okay.
But only 20% of the investors remained, or 20-25% of the original investors remained.
That's it.
Yes. So which
80%
means
have
like
sold.
80% have not got the benefit of a 20-year return of 30x on the portfolio, which is one of the best that anybody can get.
Wow. Just because they sold out.
Yeah.
And large bunch of them.
Yeah, large bunch of them. So I think that is the biggest challenge that investors face. And fortunately or unfortunately, in the last 5 years, we have not seen that drawdown. Yes, last 1 year has been challenging. It's been flat. But we have not seen the drawdown of 10%, 20%, which will test. And I hope that in the next cycle, people put in money when there is a 20% down, not remove money or pause SIPs when it is 10-20% down.
To see the real impact of the
Yes,
investment.
yes.
Yeah. What's one crucial investing skill then, that every person should try to develop?
To me, I think the biggest is discipline and diligence. I think discipline is have a very clear focus on what you're looking out for and do it diligently, and don't get swayed by the noise. I think that's the biggest, ultimately, or to put it in another words, have a better investment behavior, have a higher share of EQ. So if you look at the most successful investors, whether it's Warren Buffett or Rakesh Jhunjhunwala, they've held on to their stocks in spite of so much of noise around them, because of their discipline. I think it's discipline which clearly makes a good fund manager versus an average fund manager.
Yeah. Which in fact brings me to the question we covered about the selling part, and we've spoken a lot about how investors should hold on to their mutual fund investments. If they're starting their journey, what is the process of picking and choosing a mutual fund? How should they choose one, right? Because In all the conversations I've had, the only thing they look at is performance. That's it, which is given in every key information memorandum or scheme document. 1 year, 3 year, 5 year since inception. That's it. That's all they look at. But I'm sure there's more. Please help us there.
Yeah, see, I think the first and foremost is that the profile of the fund has to match with the profile of the investor.
Okay.
Like, for example, an 80-year-old investor should not be investing in small caps. He could probably be looking more at hybrid funds, where the drawdowns are far limited. So I think that's a big mistake which a lot of investors make, and obviously it kind of gets very easy because you have seen small caps doubling in 2 years. So anybody going and investing in small caps, because you have that FOMO effect
Yeah,
that I
yeah,
have missed it, let me go and invest. But
yeah.
that may not be appropriate for them at that particular stage. Maybe a 20-year-old can invest in the small cap at the top because he has a 10-year leeway to recover,
Yeah.
but not an 80-year-old person who may need the money 2 years
Correct.
down the line.
So match your needs with your
So I
investments.
think that is the first part, which is what I think based on my experiences with with a lot of IFAs and retail investors. I think I see a big gap between what product needs to be sold and what is the need of that investor.
Wow.
And what is actually sold to the investor. That is the first part. The second I would say is that rather than looking at the near term performance, 1 year, 3 year, look at a longer term track record of say 5 years, do a rolling return analysis of how the fund manager has done, understand the strategy, and then get into it. And probably sometimes it makes sense to have a contra bet.
Okay.
Like get into a guy who has performed well in the last 5 years or 10 years. Get into that fund when the fund is doing badly.
Okay.
Similar to the philosophy what I have for stocks. I think that is more critical. The first part is obviously align yourself with the objectives. I mean, ensure that you get the right fit in line with your risk profile. And the second point is that do a more longer term analysis of how that fund has performed. And the second important part is what is the key man risk.
Yeah.
Tomorrow if that person is not there,
Leaves the organization.
whether there's a backup, whether there's a XYZ. So that's also a very key determinant of
That's
how
often
to
overlooked
choose.
at actually. Yeah.
Yeah.
So this also made me realize one thing, that in the last whatever 5-10 years, the education levels on financial products has increased, and along with that, within mutual funds, this entire active versus passive thing. You spoke about alignment of objectives with the kind of mutual funds that you invest in. I'm just thinking about someone who's just starting their career, has like the rest of his life, working life at least, to invest in mutual fund. Very long time frame. I get that, investing into an ETF or an index fund or a passive product makes sense as to some extent. But for someone with such a long, pathway to their investments, wouldn't it also make sense to have some active component within their profile? Or is this thing that actives can never beat passive? What do you think
I
is the
think in the Indian context, definitely, I think there is a case of active beating the passive because we are a growing economy. So we have, we do have a huge basket of stocks to ensure that, even if the top ones perform, there are stocks which can, compensate for that.
Yeah.
I think the challenge comes for active versus passive, like what's happened in US. If you see in the last 20 years, it is just the top 20 stocks which is driving up the performance.
Yes.
Obviously,
Yes.
a fund manager cannot have all the top 20 stocks in
Yeah.
that same proportion. So there is a huge divergence of underperformance, or there's a huge underperformance by a majority of funds, which has actually led to passives overtaking actives.
Okay.
But in India, I think still, if you see the longer term track record, we have been able to outperform. But still, I would say for a new investor, it also makes sense to have certain proportion in passives, especially on the large caps. You can have a certain proportion in passives if you're not unsure of where to invest. I think that's a safer one to play.
Yeah, very interesting. But at least the core belief remains that in a country like India, which is vibrant, which is young, where there are a lot of companies, active can still make money. It's not like, it's.
There is a scope, but then there is a skill involved. See, in 2003, for example, 95% of fund managers beat their benchmarks.
Yeah.
But that is not the case now.
Yeah.
Today, you look at any category, it would probably be 50 to 60%.
Huh.
So I think you also have to kind of carefully evaluate
Sure.
the fund manager, the fund management company to see what has been their track record in achieving longer term outperformance.
Very interesting. So Talking about habits, again for someone in the 20s or in their 30s, what is one non-negotiable financial habit that they need to start building from today?
I think one is regular savings. So today, I find, especially amongst the new generation, I think there is a huge tendency to go towards spending.
Mm.
I think you need to inculcate the habit of saving, because which probably most of us had when we started our careers
Yeah,
25,
yeah,
30 years back, or
yeah.
even our parents started, 50, 60 years back. But today, I'm finding a lot of the young kids are more focused on spending. Like we are more moving towards the where, say, a country like US is. I think it's very important to inculcate the habit of saving, especially in today's environment where you don't know what is going to happen 10 years down the line, 20 years down the line. Your job could be taken away by AI
Mm.
10 years down the line. It's very important to
Yeah.
build a nest.
Yeah.
That is a non-negotiable financial habit that you need to develop.
Yeah. Folks, add that bit discipline and diligence that Srivatsa had said in the first half of the show. Savings habit. These are really important habits and skills that you need to have. What's the one financial habit that you still follow, even after decades in this field?
I think I started off with proper savings, with proper finding my goals and aligning for that, and I
Yeah.
still do it. And I practice what I preach. So, which means even when a drawdown happened, I never removed any money. In fact, I put in more money
Right.
into my bucket. So,
Yeah.
obviously, I can invest only in mutual funds.
Hmm.
So, I actually put in money
Wow.
into the
Okay.
mutual fund. So, that is something that I've been following very diligently in the last 20 years plus of my
Very,
investment.
very interesting. We are done with the episode, Shivasa. We always have a standard recommendation from all our guests who come out here, which is what book are you reading, or any recommendation that you can have for our audience.
Uh, See, there are two books. I think one book which I would say has completely changed my life is the little book on behavioral investing by James Montier.
Okay.
I would urge everybody to read that book. I think that covers a lot of biases which every individual has, whether it's a recency bias, whether it is a conviction bias, whether it is loss aversion bias.
Hmm.
That opened up my mind about how as an investor
Hmm.
unknowingly we are a victim to those biases
Yeah.
without realizing it. The moment you realize your biases, of course, no investor can be 0% free from biases. You will have your bias, but any kind of biases which are minimum will lead to a very, very superior long term investment outcome. So, that is a book I would urge everybody to read. It's very simple, very, very simple words. The author has illustrated a lot on investment psychology. So
That's the first one.
that's a
Yeah.
must read book for
Yeah.
any investor who's investing into the markets.
And that is the little book on behavioral investing by James Montier. Anything else? Or
The other one is the one similar subject is Same as Ever.
same
by
as ever, Morgan Housel.
Morgan Housel.
Of
Yeah,
course,
so
that's a
that's
classic.
that's far more simpler.
Yeah.
I think it highlights very, very simple facts that markets have changed, but there are certain sentiments or certain aspects of investment behavior
Hmm.
which still remains relevant even 100 years back. That hasn't changed.
Yeah. And talking about reading, tell me one thing. If any of our audience out here wants to know more about mutual fund schemes, what should they really read? Because mutual funds themselves, for example, UTI has website, you have a blog, you got a lot of interviews, you've got a lot of insights. What should be the basic reading material for every investor before?
So I think in all our blogs, specifically in UTI, I think we have detailed product notes which talks about the product and detailed presentations. Of course, I would also urge you to read the set, but that's too voluminous and it has a lot of
The scheme
legal,
investment document, Sid.
the scheme invest, but that has a lot of legal. It's a 60, it's a 100-page document. You will
Heavy,
feel bored,
yeah.
but a 10-page or a 5-page concise. All our mutual funds have a concise notes, concise presentations.
Yeah.
I would urge you to go through them to understand what the scheme is all about.
Yeah. And of course, like Srivatsa had said, check your investment advice, whoever is your mutual fund distributor or a registered investment advisor or investment financial advisor, whoever it is, sit down with him or her and get your facts right before investing. With that is a wrap on this episode of Paisa Vaisa. My guest, V. Srivatsa, Executive Vice President and Fund Manager Equity at UTI AMC. Thank you so much for doing this for our audience, really.
Yeah. Thank you, Anupam. It was a pleasure.
Thank you.